Welcome to the 5-Minute Prime Podcast. Quick, actionable tips to master personal finance and real estate investing. In just 5 minutes a day, we'll help you build wealth and achieve financial freedom. Hey, Prime investors, Martin Maxwell here, and welcome back to the 5-Minute Prime Podcast. This is episode 39, and if you've been feeling like the economic landscape is shifting under your feet lately, you're not wrong. Specifically, we need to talk about tariffs, those taxes on imported goods. They've gone from a background policy discussion to a major market mover, especially since the start of 2025. We talked about the initial impact of some recent tariff announcements back in episode 37, but things have escalated fast. Today, we're going to step back, create a clear timeline of what the heck has been happening with U.S. tariffs since the beginning of the year, focusing on how it all connects back to you as a real estate investor. First, let's level set. Tariffs are taxes the government puts on goods imported from other countries. Simple enough, but why should a real estate investor care? Because many essential building and renovation materials, lumber, steel, gypsum for drywall, appliances, copper wiring, fixtures, are imported. Tariffs on these items directly increase the cost of building new homes or rehabbing existing ones. This has a ripple effect, as we discussed in episode 31 on housing starts. Higher construction costs can mean fewer new homes get built, worsening the inventory shortage. They can make new homes more expensive, impacting overall market affordability. So, tariffs aren't just some abstract trade policy, they hit our industry directly. Let's track the key developments in 2025 leading up to this week's chaos. The tariff landscape really started heating up right after the presidential inauguration on January 20th, 2025. Since then, in early February, the administration signaled a shift with its America First Trade Policy Memorandum and began using the International Emergency Economic Powers Act. This led to executive orders imposing additional tariffs, initially 10%, quickly rising to 20% by early March, specifically on goods from China, citing national emergencies related to drug smuggling. The de minimis rule, which allowed small value packages to enter duty-free, was also targeted for elimination regarding China, effective May 2nd. Then in mid-February, a reciprocal trade and tariffs memo came out directing reviews of trade practices. Simultaneously, tariffs of 25% were announced on steel and aluminum imports globally, set to take effect in March. After that, in late February/early March, things escalated. The U.S. announced intentions to impose 25% tariffs on imports from Canada and Mexico, though initially paused for negotiation, and threatened similar tariffs on the EU. These specifically worried the construction industry due to imports like Canadian lumber and Mexican gypsum. By March 4th, the tariffs on Canada and Mexico became effective, with some exceptions like Canadian energy, prompting retaliation threats. China also faced that increased 20% rate effective March 4th. Now in early April, on April 2nd, the administration rolled out the broader reciprocal tariff regime, establishing a universal baseline tariff of 10% on almost all imports, effective April 5th, plus country-specific reciprocal rates on top of that. For China, this meant their combined rate jumped significantly. Some calculated it effectively reached 54% on April 9th. Market volatility started picking up significantly. All this set the stage for the absolute roller coaster we saw just this past week. On April 9th, let's just call it the pause and the spike. In a surprise move, the administration announced a 90-day pause on the reciprocal part of the tariffs for most countries, reverting them to just the 10% baseline. This brought a huge wave of relief, except for China. Their effective rate was explicitly hiked to 125%. The stock market initially loved the pause news, rallying sharply. And on April 10th, we saw the reality bites back. The relief faded fast. The S&P 500 dropped nearly 4% as investors digested the harsh China tariffs and the overall uncertainty. The 10-year Treasury yield, which had dipped briefly, climbed back up towards 4.4% based on YChart's data. Then on April 11th, China hits back. China didn't wait long. They officially announced retaliatory tariffs, matching the U.S. rate at 125% on key U.S. exports. Effective April 12th, they made it clear they saw this as unreasonable and wouldn't simply absorb the hit. This news sent renewed fear through global markets. Now, yesterday, markets remained highly volatile. While the S&P 500 managed a slight recovery by the end of the day Friday after significant intraday swings, The fear of a full-blown US-China trade war is palpable. Bond yields stayed elevated around 4.5%, reflecting inflation concerns. And critically for us, those construction cost worries are back, with anecdotal reports of suppliers raising quotes almost immediately due to supply chain uncertainty. The NAHB's earlier estimate that tariffs had already added about $9,200 per build to a new home now looks conservative. So as of today, Saturday, April 12th, we're left with high tensions, market volatility, and significant uncertainty. What does this mean for real estate investors trying to navigate these choppy waters? As you know, PRIME stands for Prepare, Research, Invest, Manage, and Expand, the step-by-step framework to help you build a strong real estate investment portfolio. Let's break down what a smart investor would do using PRIME. P for Prepare. This is priority number 1. Is your financial foundation rock solid? Do you have 6+ months of emergency reserves? Episode 7. Can your current portfolio withstand potential rent dips or increased vacancies if the economy slows further? Do you have access to capital if lending tightens? Prepare for continued volatility. R for Research. Hyperlocal focuses everything right now. Episode 34. National tariff news matters, but you need to know how it impacts your specific market. Is your area heavily reliant on manufacturing or agriculture, industries likely hit by retaliation? How are local construction costs actually changing? Are local builders pulling back permits? Episode 31. Your research needs to be laser-focused and ongoing. Analyze potential deals with extreme conservatism, factor in higher potential rehab costs, and potentially slower rent growth or appreciation. I for Invest. Proceed with caution. If you're making offers, ensure your due diligence is meticulous. Include robust contingencies. Now might be a good time to really explore creative financing strategies. Episode 17. In case traditional lending gets tougher, don't feel pressured to buy if the numbers feel too tight or the uncertainty too high. Sometimes, the best investment decision is to wait for more clarity. M for Manage. Keep a close eye on your operating expenses, especially potential increases in materials costs for repairs and maintenance. Stay informed about your local rental market. Is demand weakening or strengthening? This will guide your decisions on lease renewals and pricing. Proactive management is key to protecting your cash flow. E for Expand. This is where the risk-reward calculation gets intense. Does this heightened volatility create opportunities to acquire distressed assets, perhaps from over-leveraged investors or stalled construction projects, at a discount? Possibly, but the risk is significantly higher. Does it make sense to pause your expansion plans until the dust settles? For many investors, probably yes. Or should you pivot your expansion strategy towards potentially more resilient sectors, like industrial real estate benefiting from onshoring, or towards more economically stable geographic markets? This requires deep research and a clear understanding of your risk tolerance. The key message across all PRIME phases: don't panic, but don't be complacent either. So that's the tariff roller coaster up to mid-April 2025. We've seen initial policy moves, a brief pause creating false hope, swift retaliation from China, and significant market volatility. The uncertainty surrounding trade policy, especially between the US and China, is adding major pressure to an already challenging real estate market grappling with affordability and inventory issues. What happens next is anyone's guess. Will the 90-day pause for allies hold? Will tensions with China ease or escalate further? We don't know. But we do know that being informed and prepared is your best defense. Now, your challenge today: focus on your specific situation. Assess your exposure to these tariffs. If you're planning a renovation, get updated quotes for key materials this week. If you own rentals, research the main industries in your local economy. How vulnerable are they to trade disruptions? If you're looking to buy, stress test your deal analysis against a 5-10% increase in potential rehab costs. Take one concrete step to understand how this tariff situation impacts you directly. And as always, if you found this episode helpful, please subscribe to the 5-Minute Prime podcast, share it with a fellow investor, and leave us a review. You can find more resources and tools at reiprime.com. I'm Martin Maxwell. Remember, chaotic markets test investors, but they also create opportunities for the informed and the prepared. Stay vigilant, stick to your prime principles, and keep building your future. Until next time, keep learning, keep adapting, and stay focused.